Welcome to Fiscal Voyage. I'm Felix, and in this video I'm going to talk about the top 3 stocks that I consider for 2020. These 3 stocks are undervalued, and I consider them to be a great opportunity for you guys to take a look at. At the end of each presentation, I'm going to provide you a fair price of each individual companies and my recommendation and such. This video was suggested by Hanzilla. He's been messaging me and watching other videos, and he's been wanting for me to put this out, so I did this for you. So thanks again for messaging me. But these top 3 are one of my favorites. I own each of them, and I think you guys should take a look at them as well. I have a free giveaway. Basically, take a screenshot of you subscribing to this channel and liking this video, and send a screenshot to my email address, info@fiscalvoyage.com. The email address is also in the description. So simply take a screenshot of you subscribing to the channel and liking this video. When you send the email, I will provide you with a 50-page ebook that I created, which is 5 steps to finding the best dividend growth stocks. So let's get started with the top 3 dividend growth stocks for 2020 that I see now. The first one is Group. So let's get started with that one. All right, here's the stock number 1, Group, ticker symbol UNM. The company is a Fortune 500 insurance company. It basically is the top disability insurer in both the United States, United Kingdom, and also offers other insurance products, including accident, crucial illness, and life insurance. If we go over to the fundamentals, revenue grew at a small rate at 1.8% from 2010 to 2019. Net income grew at a slightly higher rate at 2.4% that same time period. The company is an investment grade BBB rated. However, net income did grow for the past 5 years at 6.1% growth. So the net income is growing slightly higher. Revenue also is growing slightly higher at 2.8 compared to the 1.8 for the past 10-year period. The one thing I do like the most here is the earnings growth of 8.3%. They've been for that 2010 to 2019 period, so earnings been going at a very nice rate, and they have a 5-year earnings average growth of 10.6%. So it's much better. The company has been growing at a much better rate the past 5 years. If we look at continue with the fundamentals, last year they had adjusted earnings of $5.44. Net margin came in at 9.2%, return on equity at 9%, and debt to cap at only 25%. So debt is very low here. Currently, the company has an outstanding dividend yield of 7.75%, which is, wow, that's tremendous. The company price right now could be flat for like the next 2-3 years, and you're still making almost 8% return annually. So that's great. I really like this. And not only that, the payout rate is only 22% based on 2020 expected earnings, so that's outstanding. So the dividend looks very safe at this period, and that dividend yield is very safe with this only 22% payout ratio. And the company has been growing the dividends for 11 consecutive years, so at a rate of 11.9%. So that's great. And their most recent increase last year was 9.6%. So they're actually going to announce the next dividend announcement will be an increase because they've been paying 4 consecutive quarters with the same dividend amount. So the next announcement should be an increase. And the 5-year dividend yield average is only 2.55%. So you're getting it almost 3 times the 5-year average at 7.75% dividend yield. So that's great, and it has a charter rule of 19.7. So it's much higher than the 11 to 12 minimum requirement. We're getting a 19.7 charter rule. For future outlook, analysts expects this year earnings to be $5.27, 2021 to be $5.49. This year is going to be lower, of course, with the pandemic from the coronavirus. Based on last year, they had earnings of $5.44. So you can see this year $5.27 is lower. It's about 3% lower than last year. Currently, however, the current PE goes for 2.7. You heard that correct. A PE of 2.7 and a forward PE of 2.7 as well. And the 5-year average PE is at 12.2. So this company is valued as if it's going bankrupt. So that's very, very attractive here at 2.7 PE. My dividend driven return model has a projected return of 26.9% annually going forward, which is wow, that's outstanding. If we look at the fast graph here, the black line is the monthly closing price, the blue is the normal PE of 8.8, and the orange is the earnings of a PE multiple of 15. So you can see here the company tends to follow the blue line more than the orange PE of 15. So it looks like the normal PE is at 8. And as you can see here, you could have a potential of 243% return in the next year or two if the company goes back to its mean. And analysts has been correct with earnings very accurately, with 100% accuracy. So that's very attractive here. So this is why this is one of my top 3 stocks for the next year or two. If we look at the fair price, CFRA has a fair price of $45.42, Morningstar at 26, FastGraph at 46, and Yahoo at $21. My dividend discount model analysis was very conservative at only 7% dividend increases, and it came out to $31.04. Averaging out the 5, we get a fair price of $34.77 a share. And currently, like I said, the company is going for $14.71, which means it's undervalued by 136%. That's why I have a buying recommendation for I personally been buying shares of this company, and I'm loving the dividends, and I'm continuing to buy shares. This is where I'm pouring most of my money, but make sure you do your due diligence as well. But I highly recommend you taking a look at this company for future investment. I love the safe, high dividend yield. The dividend growth over the past 5 years has been outstanding at 9%. Earnings, however, is going to be flat, almost 2% growth of earnings. However, what makes this company so attractive is the valuation. It's priced right now as if it's going bankrupt with a PE of 2. So that, and the book price to book ratio is like 3 times lower than the 5-year average. So that's still another attractive aspect of this company. So make sure you do your due diligence. So let's get on to stock number 2. Number 2 top stock for 2020 is AbbVie. So let's get started with that one as well. AbbVie Inc. is ticker symbol ABBV, is a biopharmaceutical company founded in 2013, which originated as a spin-off from Abbott Labs. Fundamentally, the company from 2010 to 2019 had revenue growth of 8.8%, net income at a smaller rate of 7.3% in that same time period. Currently has an investment grade A- credit rating, and operating income grew slightly higher than both revenue and net income at 11.5% in that 10-year period. The biggest thing that stands out here is the earnings growth, which was from the past 7 years is 19.1% growth, and the last 5 years it grew higher at a 20.2% growth. And look, in the next slide, we'll see the dividend growth because of these earnings growths. Also, the net income for the past 5 years grew at a higher rate at 11.3% versus the 10-year of 7.3%. The same thing for the revenue 5-year average of 9.8%. If we look at more fundamentals, last year the company had earnings of $8.94. Net margin came in at respectable 23.6%. Return on equity at 140.6%, which is a 5-year average, but that's outstanding. Their investments has 140% return on the equity that they build. Debt to cap 106%, which is high, but it's not concerning because they have a good credit rating. Currently, the company has a dividend yield of 5.12%, which is great, versus their 3.89% 5-year average. So it's almost 200 or so basis point higher currently. They have a respectable, modest 45% dividend yield, dividend payout, which is great. It'll help continuing the growth of the dividends going forward with the low payout. They've been growing dividends for 7 years, and the past 5 years growth rate has been 20.9% increases average, so that's outstanding. Their most recent increase was last year in November at 10.3%. Currently, they have a charter rule of 26, which is great. We like to see a charter rule of 11 or 12 and higher. Obviously the 26 is going to be going lower as time progresses because they won't be growing dividends at 20%. I'm expecting a nice 8%, 10% increase come November this year. Future outlook, 2020 is expected to earn $10.43, which is almost $2.40 higher than the current earnings of $8.94 of last year. 2021 continue that growth at $10.94. CFRA has a projected earnings growth of 4% for the next 3 years, and my dividend return model came in at 13.1% return annually going forward at this price. Currently, the company has a PE of 9.7 and their forward PE of 8.8. That's how I like to see it. The current PE is higher than the forward PE because the forward PE looks at earnings for this fiscal year versus the current PE looks at last year's earnings. However, both are still much lower than the 5-year PE average of 13.9, so that is a good indicator of undervaluation. If we go to the fast graph, the black line again is the monthly closing price. It looks like the company likes to follow the blue line, which is a normal PE of 12.9, so you could say 13, as we saw the 5-year average. And right now, as you can see here, if these earnings were accurate, and for the most part, analysts has been accurate with projecting earnings, you have the potential to get a return of 62.7%, which is include dividends and capital appreciation in the next 2 years. So that's very, very attractive here. If we look at the fair price presentation here, CFRA has a fair price of 86, Morningstar 97, Fast Graph, as we just saw, $135 a share, Yahoo 93, and my dividend discount model analysis at 132. That number I came up with 8% dividend growth for the next 3 years and 6% after that with a discount of 10%. So that's how I got that $132. Averaging out the 5, we get a fair price of $108.90. Currently, the company goes for $92.10, meaning it's undervalued by 18.2%. And it gives us that margin of safety of 10% or higher that I like. That's why I have a buy recommendation, and it's my second top choice company in this video. I love the company because it's shareholder friendly. The dividend growth has been outstanding. Payout ratio at 45% is great. The debt level is concerning, but again, they have a great credit rating of A-. The valuation is attractive. It's not great as it was in March, but it's still very attractive, and that's why I have a buy recommendation. All right, and last but not least, Altria Group. Altria Group, ticker symbol MO, is an American corporation and one of the world's largest producers and marketers in tobacco, cigarettes, and related products. We look at the fundamentals. Revenue only grew at a very low rate of 1.8% in the 10-year period. However, the past 5 years has actually been less at 0.5%. So revenue has been basically flat this whole period. Net income was negative as last year, 2019, they had a negative net income results. S&P credit rating of BBB was investment grade. Operating income, however, had a growth of 5.9% over that 10-year period, and earnings in 10-year period had a 9.3% growth, and for the past 5 years it's been dropping at 4.66% growth. We continue with the fundamentals. 2019 earnings came in at $4.22. Net margin came in at negative as the net income was negative as well. Return on equity at negative 12. Debt to cap 73%. The return on equity I expected this year to be positive, around 25 to 30, because in 2018 debt return on equity was 35%. So I expect it to be positive this year. Charter rule came in at 19, which is the 5-year growth rate, which is 10.4%, plus the current yield of almost 9% came in at 19, so that's great. The past 5-year dividend yield average is 4.68, so you're getting a double the past 5-year average. Of course, with the pandemic, a lot of prices dropped because of that. So we're getting a lot of great dividend yields during this time, so a lot of opportunities. The last dividend increase was 5%, and I'm expecting another one increase in August sometime. So I'm expecting around 4 or 5% as well, because CFRA has a projected earnings growth of 4%, as well as some Yahoo analysts and others that I've seen around. So 4 to 5% earnings growth as well as dividend growth is my expectation. 2020, they expect earning of $4.25. 2021, $4.51. My dividend drill return model came in a projected annual return of 13%, which is good. Like to see it 9-10% or higher. We're getting 13% here. Current PE of 8.9, the same as the forward PE of 8.9. It was slightly a little less, as you can see, because analysts expect at least a 1% earnings growth for this year. However, it is much lower than the 5-year average PE of 17.6. So that's right there is a great indicator that the company is undervalued. If we look at the fast graph, the black line against the monthly closing price, for the past 8 years, it looks like the company was trading at a normal PE of 17 or higher. I'm not even going to use the normal PE as the fair value price. I'm going to use a PE of 15 and maybe even a 12, between 12 and 15. And even then, you're still looking at possibly 94% return in the next year or two. So that's a good indicator here that the company is undervalued. And analysts has been right with the earnings projection quite high with their accuracy. Fair price, CFRA has $44. Morningstar 54, Fast Graph as we just saw 63, and Yahoo $47. My dividend discount model analysis had a low dividend growth of 5% and 4% going forward. Gave me the $59.84, averaging out to 5. We get a fair price of $53.90, and current price, Altria Group goes for $37.73, meaning it's undervalued at 42.9% undervaluation. Therefore, I have a buy recommendation, and that's why it's my number 3 top stock for 2020. It has a 50 years dividend growth, high current yield, and is safe for the foreseeable future. It's only a modest, fairly high 70% payout ratio, but they've always been paying that for the past, 15 years. The only concern I have really is the earnings has been slowing down, and I continue to see that going forward. But it's still growing. The high debt and the low credit rating of BBB. But other than that, I think the company is worth a look, and I have a buy recommendation. I personally own it. It's a high percentage of my portfolio right now, but I think you guys should take a look at this. So there you have it, the top 3 stocks for 2020. Again, make sure to like and subscribe to this channel if you found it informative and entertaining. And also, if you do that, make sure to take a screenshot and send it to my email address, info@fiscalvoice.com, so I can send you a free ebook, a 50-page ebook on 5 steps in finding the best dividend growth stocks. So see you guys in the next video.